This year, the semiconductor index is up about 90%, and the single most important company in that entire boom, the one whose chips train every model you've heard of, is up just 6%. Nvidia, the king of artificial intelligence, is somehow the worst performing chip stock of the year. Hey, I'm Jaden, and this is where we break down what really moved the market the way nobody else will. None of this is financial advice, it's the story behind the numbers. And real quick, today's video is sponsored by Made in Dina. I'm repping the gear right now, links in the description if you want to grab yours. So why is the king getting left behind? Because Nvidia got so dominant and so profitable that it gave everyone around it a reason to come after the throne. Let me show you who and how. Look at that gap. Over this year, a chip supplier like Micron is up more than 200%, Broadcom's up too, and Nvidia, the company at the center of all of it, is the flat line down at the bottom. Same boom, wildly different winners. So what is the market seeing in Nvidia that it doesn't like? Start with Nvidia itself. The stock keeps testing $200 and bouncing. It is built to floor there, but it can't break out. Now, you'd assume a company this dominant must be wildly expensive. It trades at about 30 times earnings. That sounds steep until you look at the growth. Earnings per second hair are up 67% over the past year, which gives it a PEG ratio of 0.64. Anything under 1 is considered cheap for the growth you're getting. So this isn't a valuation problem. The market isn't selling Nvidia because it costs too much. It is hesitating because it is not sure the dominance lasts. And the reason why is everything in the next few minutes. While Nvidia sat still, look what the supposedly boring company did. Micron, they make memory chips, the least glamorous corner of the industry, just reported earnings of $25.11 a share. A year ago, that number was $1.91. Revenue, $41.5 billion, up 346%. Gross margins of 85%. Every one of those is a company record. The stock jumped 14%. Memory used to be a commodity business with brutal cycles. Now 61% of Micron sales come from data centers. The shovels are worth more than the gold. Okay, here is the part most coverage skips, and it is the whole story. When Nvidia sells you a chip, it keeps a margin somewhere north of 75%. 75 cents of every dollar if you're a small startup, you pay it. But if you're Google or Amazon or OpenAI, spending tens of billions a year on chips, that margin is the single biggest line item you could ever attack. So they don't keep paying it, they design their own silicon. Every dollar of Nvidia's fat margin is a dollar of someone else's incentive to replace them. And this week, the biggest customer of them all made its move. OpenAI unveiled its own chip. They named it Jalapeño like the pepper. Built with Broadcom silicon and Celestica's racks, designed specifically for running AI models at scale. It joins Google, Amazon, and Meta, who already build custom chips. The whole point is to lean less on Nvidia and cut costs. One analyst put it bluntly, when your supplier is taking 75% margins, you find another path. Broadcom has quietly become the arms dealer to everyone trying to escape Nvidia, and that is a very crowded room. But here is the counterweight, because not every challenger wins. Cerebras, an AI chip startup that IPO'd in May at 185, reported its first earnings as a public company. Revenue beat, up 94%, and the stock fell 15% anyway. Why? Their margins are getting squeezed by their own $20 billion deal with OpenAI. Demand is coming in faster than they can build, so they're renting equipment back at a loss to fill it. 19 of its first 26 trading days moved more than 3%. The lesson, arming up against Nvidia, is expensive, and the market is merciless about who is actually making money doing it. And looming over all of it is Masayoshi's son. This week, the SoftBank founder stood up and said his goal is a net asset value of $6.2 trillion on the back of what he calls super AI. He is expanding the Stargate data center project. He is mass-producing AI robots. He wants to be the #1 AI robot company on Earth. When the loudest money in the world is talking in trillions, you're either very early in something enormous or very late in something fragile. Usually, it is a little of both. Step back, and this fits a bigger pattern. The Wall Street Journal called it Mag 7 to Lag 7. For 2 years, more than half of the S&P 500's entire return came from 7 stocks. This year, they're trailing the rest of the market. We've seen this movie, the Nifty 50 of the early 70s, a handful of one-decision stocks everyone owned, until they didn't. The ones who held on did fine 25 years later. The ones who needed the money sooner did not. Concentration feels safe right up until the moment it doesn't. So let me tie it together. Nvidia isn't broken, it is still throwing off almost $100 billion in cash and handing half of it back to shareholders. What changed is the structure around it. Its own success, those enormous margins, became the reason every giant customer is now also a competitor. That is why the king is stuck at 200, while the suppliers and the challengers run. The AI boom is bigger than ever. It is just no longer a one-stock story. The lesson here isn't sell Nvidia or buy Nvidia. It is that dominance creates its own competition. The fatter the margin, the bigger the target on your back. Watch the margins, watch who is building their own chips, and you'll understand this market better than most of the headlines. That is the real story. Now you know how it actually worked. I'm Jaden, thanks for watching.